Welcome to this explainer. Okay, so we all absolutely love finding premium goods on a massive discount, right? I mean, who doesn't? But applying that exact same logic to the stock market, well, that requires a very specific, highly disciplined framework. Today, we're diving deep into the anatomy of value investing to see exactly how the pros exploit market inefficiencies.
Okay, let's dive into this. Here's our roadmap for today. We're going to cover finding discounted premium assets, 4 key metrics to assess value, what the margin of safety actually is, how to beware of value traps, and finally, we'll wrap up with the value investing mindset.
So, Part 1. Finding discounted premium assets. The entire logic of value investing really rests on one massive divergence in the market: price versus intrinsic value. You know, price is simply the market's current asking rate. It's just that number flashing red or green on your screen. But intrinsic value? That's the actual fundamental worth of a company based on its hard assets and its cash flows. Our ultimate goal here is to find that sweet spot where the trading price is sitting way below the company's true intrinsic value.
Think of it like everyday shopping. We aren't looking for cheap, low-grade knockoffs. We're hunting for discounted premium assets. These are robust, top-tier businesses that the broader market has just temporarily put on sale. And usually, this happens because of some short-term pessimism rather than any real structural flaw in the business itself. It's a high-quality asset just sitting there in the clearance bin.
All right, Part 2. 4 metrics to assess value. Let's transition from theory to the actual practical tools. To evaluate a company's real potential, we're going to use 4 critical quantitative metrics. Think of this as your essential diagnostic toolkit: a low PE ratio, a P/B ratio below 1, a high dividend yield, and robust free cash flow. Let's start with the PE, or price-to-earnings ratio. A really low PE ratio fundamentally means you're looking at a much shorter payback period to recover your costs. Why does this happen? Well, often it's because the market is just temporarily giving the stock the cold shoulder. You know how markets are? They can be notoriously irrational. Sometimes they'll completely abandon a perfectly solid company just to chase the newest shiny trend, and boom, that creates the perfect entry point for a disciplined investor.
Next up is the price-to-book or PB ratio, and this brilliantly illustrates how you can build a safety net. Finding a PB ratio below 1 actually means you are buying the stock for less than the company's stated liquidation value. So literally, if that company were to close its doors tomorrow and sell off every single physical asset they own, you're buying in at a discount to that total value. It's a massive structural safety net.
Then we have the high dividend yield. Because value stocks are so often these mature, established companies, a high yield is a great sign. It indicates they have stable, reliable cash flow and a proven history of returning profits straight to their shareholders. This is huge because value stocks often reward you with steady cash while you're just sitting back, patiently waiting for the broader market to finally wake up and correct the stock price upward. Our fourth tool is free cash flow. This is simply the money remaining after a company has paid for all its capital expenditures. Basically, the cost of keeping the lights on and maintaining current operations. Having abundant free cash flow is absolutely crucial. It ensures the company actually has the financial padding to survive unexpected economic downturns, or the flexibility to intelligently reinvest in its own future.
Moving on to Part 3. What is margin of safety?
This brings us to the ultimate shield for any investor: the margin of safety. This specific concept was championed by the legendary Benjamin Graham, the widely recognized father of value investing. And for Graham, this mathematical buffer wasn't just a nice-to-have metric. It was the absolute prerequisite for risking your capital in the first place.
Let's do a really quick mental math exercise to show how this works. Imagine you've rigorously run the cash flows, evaluated the hard assets, factored in all the growth projections, and you determined that a company's true intrinsic value sits at exactly $100 per share. You've done the deep analytical work, and you're confident in that $100 baseline.
But then, maybe due to a crazy market overreaction or a missed earnings whisper or just general macroeconomic panic, you pull up the ticker and see that the current asking price for that exact same equity is only $70.
That 30-point gap right there, the difference between your $100 intrinsic value and the $70 market price, that is your margin of safety. It acts as an incredibly crucial cushion. Because if your initial forecast was slightly off, or if the market suddenly goes haywire with extreme volatility, that 30-point buffer protects your capital from a severe loss. It is literally built-in risk management.
Let's shift gears a bit for Part 4. Beware of value traps. Which leads me to ask, is cheap always a good thing? I mean, a low price tag definitely triggers our natural bargain hunting instincts, right? But in the stock market, you have to approach cheap with a healthy dose of suspicion. It's dangerously easy to mistake a sinking ship for a submarine.
So the crucial point here is that you must rigorously distinguish between a temporary discount and a permanent decline. The entire analysis really hinges on this. Is the stock simply cheap and misunderstood by the market, or is the underlying business actually declining and structurally failing?
Because, let's be honest, some companies have low stock prices for entirely justified, terrible reasons. They might have completely lost their core competitiveness to a rival. Maybe their underlying technology is just fundamentally outdated. Or you could be looking at a massive, systemic failure by the management team. Guys, these are not temporary discounts. These are permanent, glaring red flags.
And this brings us to a major warning. If an investor only looks at those financial metrics we talked about earlier, but completely ignores the company's competitive advantage, its economic moat, they are going to fall right into a trap. You'll end up stuck in a declining asset where the stock price just stays low forever. And that promised intrinsic value, it's absolutely never realized.
Finally, Part 5, the value investing mindset.
Now, no explainer on value investing would be complete without talking about Warren Buffett. And a defining trait of his philosophy, and really of successful value investors in general, is contrarian thinking. It's that rare psychological ability to step back, hold on to your conviction, and think completely differently when the rest of the herd is in full panic mode.
In practice, this means acting inversely to the herd. When the market is gripped by extreme fear and everyone is panic selling, true value investors do not join the exodus. Nope. Instead, they do a calm, rational assessment of the company's fundamentals. They buy when others are fearful, and they just patiently wait for the market to eventually rediscover the true worth of that asset.
Which leaves us with one final, very important question. Do you have the patience for the marathon? Because this isn't some short-term algorithmic trading game. It's a marathon where time is your greatest ally in correcting market irrationality. So the next time the market plummets and absolute panic sets in, ask yourself, are you seeing a crisis or are you actually looking at the greatest sale of the year? Thanks for joining me on this explainer.